which is all about the property. Section 6.1 is on property options, starting on page 151 in your book, in your manual. Property options for the homeowner looking to purchase may mean they're looking at new home sales, and in your book, in your manual, you'll see that there are always trade-offs when looking under different options. Under the new home sales option, the trade-offs might be brand new neighborhoods aren't complete, you don't know where they're heading, the builder could go out of business, or you could be one of the first homes in the neighborhood and wake up every day to loud construction. So with each one of these points, there are always trade-offs. The for sale by owner situations, if you don't have somebody who knows about contracts and such, you may get stuck in a bad transaction. There are other downfalls and upsides and downsides to that. Most people do work with the realtor, and of course, there are trade-offs there too. You're going to pay for this service, but also you may be better protected using a realtor. When searching for real estate-owned properties, the big trade-off is that these bank-owned properties are often cheaper perhaps, but you don't know what you're getting, and the bank is usually looking for cash buyers, and that's the same way for short sales. The bank is again usually looking for buyers with cash, and you may not have some of the upsides you do to working on regular types of purchases. A homeowner can find a lot of benefit working with nonprofit developers, however. We'll look at that a little more closely in a minute. And also there can be advantages to self-help housing and purchases where sweat equity is employed. So let's look at the nonprofit organizations as affordable developers. These organizations may offer comprehensive services for buyers. You probably work in an organization similar to this, or else you have a partnership with an organization. Either way, the home buyer is going to benefit from pre-purchase counseling through this nonprofit or through a partner nonprofit. Some of these NPOs offer their own mortgage financing. Some administer subsidies. Some of these organizations build new construction, and they also acquire existing homes for rehab purposes. With the self-help or sweat equity options, we're thinking of situations such as what is found with, say, Habitat for Humanity, where the home buyer, along with the local nonprofit, participates in the construction. You'll typically have a lower house price because you're trading cash for sweat. And obviously the affordability is geared toward the very low and low income households. In terms of purchases going this route, rent to own route, I have a big red warning here. The problem with rent to own is that although the landlord has obligations to keep the property in decent condition and keep it safe, if they're considering you the owner, they may not do so. So if the hot water heater goes out, when normally it's the landlord's responsibility, not the renter's, in this situation, the landlord may consider the renter liable for repairs and even for the taxes and insurance. Sorry about that little glitch. Had a slight personal emergency there that I had to take care of with my family. Okay, so the warning with the rent-to-own issue is that the owner of the property has to decide, am I the seller or am I renting this property out? But they can't do both. So if he decides he's a landlord and renting the property, he or she, then, now my system's not moving. Okay, there we go. Then he must follow the local landlord and tenant laws, of course, and keep it up his responsibility, her responsibility to keep the property in good repair, make repairs as needed, and the only time the landlord would be allowed to evict a renter is when the renter breaks the lease. If the landlord has determined that this is a sale, then they would have to follow state laws for foreclosing on the property, and of course that could take a long time. I guess it's not as long now as it used to be, but it can take a long time. It takes longer than eviction anyway. Either way, they can't have it both ways. Either the landlord needs to be considering himself, herself a landlord or a seller, not both. Lease with an option to buy. This option is where the property is rented, and then the tenant has the right to purchase it later for a prearranged amount. And in the meantime, a portion of that rent is being saved up each month and is counted as future credit toward the purchase. These types of agreements can come in many different forms, and it's really important to understand the terms. One downside is if the client initially agrees to purchase but later they change their mind and don't purchase, they may lose the money that was designated for the purchase. So other problems with lease-to-own property is that they're typically sold as is, so the bank isn't involved demanding an inspection, and so no inspection is required. The buyer may be buying a home that appears to be fine at the time, but later they find structural problems. And because the landlord or the lessee typically writes up the contract, these contracts are typically written in favor of the lessee. So when you're dealing with the client who is considering a lease with an option to buy, have them bring in a copy of the lease-to-own agreement before they sign so you can review it. And if you see anything odd, you may need to recommend that the client have the lease reviewed by an attorney. There are more warnings out there, and these are related on this slide to buying foreclosed properties. That starts on page 157 in your manual. You'll see in the manual that it mentions that the process of buying a foreclosed property is highly impersonal. These are usually large corporations, large banks, and they're just interested in the numbers and the bottom line. The buyer isn't going to expect to see disclosures. You would inform your client of that. Prepare your client to see homes stripped bare. I've seen homes stripped of pretty much everything, including cabinetry, tubs, toilets, faucets, and everything else you can imagine. And you can't expect the bank to give any credits or to fix anything. Again, they're just trying to get rid of this property. And you're gaining it at a very low cost in exchange for walking into that as-is situation. The bank's going to have its own processes, and basically they're in the driver's seat. Section 6.2 is about the real estate contract, starting on page 159 with the text, and then a sample real estate contract begins on page 160 and continues through page 170. On that contract, you see the typical names of the buyer, names of the seller, description of the property, address or lot number, that type of thing, unit number. Then a listing of which fixtures remain in the sale. The appliances are included here, the curtain hardware, sometimes window treatments, and other things that remain with the house in the sale. The amount of money the buyer puts down to show that they are earnest about purchasing the property will be listed. The purchase price, of course, will be listed. You'll see on the contract the date of closing. You can walk through the manual to see these sections are all highlighted in the manual. There will be a date for when the buyer is allowed to take possession, and a signature of the buyer acknowledging that they've received the proper disclosures related to lead paint, asbestos, mold, or that type of thing. And there will be information about proration, meaning that the seller will be paying all of the charges, property charges, up to the point of sale, prorated up to the point of the sale. And both the buyer and the seller have the right to have an attorney review the documents. There's a section for that in the real estate contract. Also, the regular inspection that's recommended, basically, for the buyer. Any contingencies related to the mortgage, such as a contingency that if the buyer does not get financing, they can end the contract. There will be a space for, you'll see that in the manual, a space for the insurance clauses. A common area related to condos, condominiums will be described, basically explaining ownership of the common area. See all the closing documents in the real estate contract referred to, such as title deed, and that sort of thing. There will also be a damage clause related to the seller leaving the home in the same condition as when the buyer last saw it, or that the buyer also doesn't damage the home during the final walkthrough. And some states will have their own particular clauses. The sale contingency is more related to if a buyer is trying to sell a home before closing on the new home, then there will be a contingency in the contract to that effect. Miscellaneous inspections are beyond the general inspection and have to do with what's mentioned before with termites or asbestos or radon or that type of thing that the borrower is responsible for, or the buyer, I should say. Section 6.3, we're going to look at the home inspection process starting in the manual on page 170. And the inspector's first looking at the big picture regarding the exterior of the home and then the interior of the home. So they get a broad view first. And they're looking at the condition of the systems, the plumbing system in the house, the electrical and structural systems, and the heating and air. Items that aren't included in a home inspection, which should be duly noted, important to note, that the inspector is not responsible for being able to identify asbestos or radon gas or lead paint or toxic mold, or whether there is pest damage, say termite damage or other types of pest damage. These are specialized types of inspections that the buyer may want to do for their own protection. With a house, so many problems can occur. You're probably aware of many of these. They're described starting on page 172. The inspector's going to look at the roof, look for sloping, missing shingles, detached shingles, that sort of thing. Chimneys, looking for grouting, flashing problems, leaning chimneys, the eaves and the fascia, making sure there's no rot and that there's no bare wood. Gutters and downspouts, checking that they're attached and not clogged up and there's proper flow away from the house. Wall coverings, paint or paper or whatever, that it's looking for water stains, cracks, and the like. Windows and doors, checking for fit, age of the windows and doors, that the seals are intact, porches and decks are solid and attached correctly according to code. Foundations, looking for moisture problems, missing parts of the foundation, leaning foundation, sinking foundations. The lot area around the house, looking for the slope and drainage and how close the trees and bushes are to the house. Basements, mainly checking for moisture damage. That's a big problem with basements since they're under the water line and water is always an issue. Checking the floors for sloping floors or weak boards, structure of the floor. Checking the walls for integrity, cracks in the walls or ceilings, stains again. The bathrooms and kitchens for functionality, basically, safety. And checking the electromechanical systems, heat pump, or other ways of heating and cooling the house. Section 6.4 is about the appraisal. Starts on page 175. Section 1 will list the address, and the appraiser will just be checking that it's the same as the address in the rest of the file and that the legal description also matches. Same way with the sales price, it's the same as on the contract. And that if there are any seller concessions, the appraiser has to check to make sure that whether there are or not, because some mortgage programs don't allow them. The appraiser is going to list what he finds the real estate taxes of record are for the property in that section, and any homeowners association dues, because the underwriter is going to take those into account. Property rights appraised has to do whether this is fee simple property or the rare kind of leasehold property you can read about on page 176, or whether it's a condominium type property or a PUD. Section 2 is regarding the neighborhood. Location has to do with whether it's urban, suburban, or rural. Built up has to do with whether how much of the area is, or the available land is being used for housing. They're generally looking that it be more than 25%. When there's not a lot of use, there's some concern about future sale of the property. Also, the appraiser is going to be checking growth rate in the same way. Is there rapid or stable growth? Slow growth would indicate that maybe this property could one day be hard to sell. That affects the value. And speaking of value, they're going to be looking at whether values are increasing or if they're declining or just stable. Obviously, a declining value home would put the lender and the borrower at risk. Demand and supply is checked out because a shortage of housing indicates that there's a lot of demand, and that keeps the value up. Marketing time is also an issue because when in areas where homes are selling by 6 months after being listed, it indicates a stronger market, and the lender then has a little more ease in lending in a good market. Present land use is looking at whether how many of the homes are single family, how many are multifamily, and if there's commercial, industrial properties, and if there are vacant properties. Some areas where there is a lot of commercial or vacancies can cause a decrease in value. And then they'll also be looking at whether the area around the house is starting to change in terms of being used for different purposes, and that can affect the collateral. Predominant occupancy is talking about, again, vacancies, and if there are more owners or more renters, and the appraiser has to explain any negative factors, anything that would adversely affect the property value. Single-family housing is checking out the average property price. They look at the lows and the highs, and the lender is typically searching for something in the middle. Neighborhood analysis is defining the availability of the surrounding area, if there are services and conveniences nearby, or if there's just not very good access to services. In the comment sections, anything else that the appraiser wants to state, there will always be a note that reads that, quote, race or the racial composition of the neighborhood is not considered a reliable appraisal factor, unquote. And this is to prevent redlining and other discriminatory actions. Under Section 3, the appraisal site, the appraiser is going to be looking at the size of the property, measuring it by width and length. Going to also look at the site area and describe it as compared to other properties in the area. Is it a cul-de-sac? Is it a corner lot? A cul-de-sac may be considered more desirable than a property that backs up to a freeway or is close to an airport. And the property must be zoned for residential use, and we don't want to be looking for residential properties in a commercial zoned area. Highest and best use has to do with a property being used in the best way. For example, if a property is situated in the middle, as we mentioned before, of lots of industrial areas, then maybe it's best suited for industry rather than residential. They'll be looking at utilities in the area, and if it's a home with a well and septic, and there are public utilities nearby, with FHA loans, they may require the seller to hook up to public utilities, which can be a big issue and very expensive, so it's worth checking into. When the appraiser's looking at site improvements, they're looking for any improvements, sidewalks, new roof, whatever, and supposedly the more improvements the better. And one last thing is the appraiser will look at the topography, the shape of the land, the view of the land, lake view, or if it's subject to flooding, and that can be big trouble if the home is in a FEMA flood hazard zone. Then there, again, in this section, there's a space for comments, maybe where the appraiser would describe any assessments or easements or encroachments. It's more common than you would think to have an encroachment and have to get an easement. Section 4, the appraisal improvements. There's a general description first on the number of units, whether the house is attached or unattached, and that means whether it's a single detached dwelling or attached to other homes, the age of the home, or if it's new construction, how many units are in it, and that sort of thing. And then the appraiser will be looking at the exterior description of the home. Again, back to the foundations, walls, roofs, gutters, screens, windows, making sure that the downspouts are there and that they're in the proper position. Then we mentioned foundation before, but mentioning it here again in terms of improvements, where the appraiser is partly depending on what area of the country it's in. In some areas, the foundation is going to be subject to more infestation by insects than in others. And it's the same way with basements. In some areas, a basement is desirable and more common. In other areas, it's not. Insulation is another type of thing that's reported by the lender, the threshold of the insulation, and at this point it's also a place where the appraiser can note anything about insulation and energy efficiency. Section 5, the appraisal room list. The appraiser's listing the number of rooms on each level of the home and the square footage. And also, we'll be reporting the finished area above grade because the properties are appraised using above ground level rooms for square footage only. That was a surprise to me when I learned that. Section 6 has to do with inside the home, and in all these cases we're looking that the inspector is marking things at least not poor. So on surfaces they're looking at material of the floors, walls, baths, fireplace. They'll note whether you have a higher grade of surfaces. The different grades don't affect approval of the loan, but maybe can have something to do with value. The lender is going to make sure the heating and cooling systems are adequate. They're going to make sure that at least the basics are there in kitchen equipment. If we have an important appliance missing and this loan is shaky to begin with, depending on the new buyer who is trying to get a loan to have to use some of their money to purchase appliances can kill the deal. Also, the attic will be inspected and for health and safety issues. And under improvement analysis, in the book it talks about how the underwriter is looking for something they call functional obsolescence. So they mention in the book that some older homes may not have closets in a bedroom, so then it can't be counted as a bedroom, and that it's obsolete in that sense. And sometimes homes have added rooms, but access wasn't considered, so they have an egress-ingress problem when you have to pass through one bedroom, say, to get to another bedroom. The auto section is all about garages and carports and whether it's attached to the house or not, and if it has electric door openers, and finally how accessible it is to the main house from the garage. In Section 6, the appraisal makes comments about any additional features, such as a pool or some other extra feature. They also make comments about depreciation to see if there are any inadequacies that are affecting the marketability of the home. Making comments also about just general market conditions in the area, whether things are declining or expected to increase in value because of something that's happening nearby. In Section 7, you'll see the appraisal cost approach, and it describes in your manual the building sketch that the appraiser will make on this big blank space that's left there to sketch the above grade area. And they'll do the estimated reproduction cost here, which gives dollar amounts for rebuilding the dwelling. And the lenders are going to make sure that the land in these cases doesn't represent a higher percentage than what they find acceptable. Generally, that's 25%. They don't want the land to exceed 25% of the total value of the property. Section 8 is where they make the comps, the comparables, the comparables, whatever you call them, and make the comparison, and they do the adjustments. So they look at the subject value and compare it to other homes, and they're looking at one house compared to the other. There's not always agreement among appraisers. You find also lots of argument there. And, they may have to subtract because of comparables, or if a comparable doesn't compare, add to the value of the home. And back to this slide that I almost skipped over, just to say what's on the slide, that's the bottom line on the value. Okay, so moving on then to Section 6.5, which has to do with homeowners and flood insurance. That starts page 183 in your manual. all familiar with what homeowners insurance is, and I think we know why lenders require it. Of course, they have a big investment in the property, and by losing that property to a storm or some other damage, they lose money. So that's why they require it, obviously. What can be protected in single-family dwellings and others is the outside structure and the inside as well, and it also protect on cases of liability. It can protect anybody on the policy, the spouse, the residents of the home. You got to remember that renters aren't usually protected, but it can protect your household employees, your guests, your visitors. As if I had a household employees. Ha! And property insurance protects the actual home or the dwelling also. Often it reimburses for theft as well, and personal injury or damage to somebody else's property. And what is not protected? Well, the land underneath the house is not protected, so this would be in cases of an earthquake. Or if any kind of damage that happens exceeds what's the coverage amount that has been stated in the policy. Flood damage isn't protected. You have to have a separate policy for that. If you have a business loss or a loss related to business activities in the home, that is not protected. There's extra riders for that. And again, I mentioned that a tenant is not protected. Any claims that were covered under pre-existing insurance won't be covered under current insurance. And many natural disasters are not covered under insurance. Flood insurance, of course, is just what it says it is. It's not the lender who decides that it's needed. The homeowner themselves can just voluntarily choose it. But in some cases, it's required by the federal government. And this is determined by zoning. This is the Federal Emergency Management Association, FEMA, that makes this determination. And once they make that determination, there are no exceptions unless you somehow get them to review and pay to have them come and somehow you can prove that you're really not in a flood zone. The zoning can change. It can shift from year to year. So it also can be hard on the homeowner because this type of insurance, flood insurance, can't be paid on a quarterly or monthly basis. It has to be paid in full once a year. It's an annual policy. In your manual, you'll see the old HUD-1 settlement statement form. And as you learned in Pre-Purchase 1, that form is no longer being used. It is in your manual there from page 185 through 194, in case you have to refer back to it for any reason. But we have moved on, and HUD has changed the rules again, and the old HUD-1 is not pertinent any longer. In Pre-Purchase 1, you went to the CFPB website at consumerfinance.gov, and you looked at the new LE and the CD, the closing disclosure there. So if you're rusty, go back and check it out again. Get familiar. You'll be looking at that form, the new forms from now on. You can also find that form on page 289 in Appendix B. One last section on home warranty, starting on page 194. Oh wait, I think there might be, actually there are two more sections. The home warranty, and then we're going to talk a little bit about refinance. So in terms of a home warranty, let's first talk about the pros of a home warranty. A warranty may provide for some new homeowners a little bit of peace of mind, knowing that some repairs or a lot of repairs are covered, and that when something happens, they just need to call this one number and They won't have to start going down a list of providers to find a good provider. And oftentimes this warranty is provided free by the seller as part of the contract. But there are also cons to, looks like everything else, there are upsides and downsides. So the cons to the home warranty is that if the seller didn't provide it, the borrower will have to pay for it, and the annual fees usually run $400 or $500 or sometimes more per year. Also, another con to the home warranty is that each time a service call is made, there are service fees and charges for the trip out to the house. And if there are two services needed, say two separate services, say for example you have both an electric problem and a plumbing problem, you have to pay a separate fee for each service. And just like insurance companies do, warranty companies may often try to reject the claims by saying that the problem was because of a lack of maintenance. This might especially happen when the repairs are extensive and expensive. Sometimes the service representatives are told to just fix the item, just do a repair, don't do a replacement. And then it's a revolving issue or recurring problem. They have to come and repair it and then come back again and again. A resource of a home for a resource for you, there is a home warranty example found in Blackboard. Now we'll look at section 6.7, which is the cost-benefit analysis of a refinance, starting on page 195 in your manual. Again, in Blackboard, you can find a net tangible benefit form, an example there. So why do people refinance? Some of the reasons why are that they found that interest rates are lower now, or they qualify now for a lower interest rate, and getting this lower interest rate can reduce their monthly payments. Of course, in that situation, your client does need to look at the cost of refinancing and compare it to what they'll be saving and kind of look ahead to when the break-even point is. For example, if closing costs are $2,000, just to use a number, and it lowers the payment by $100 a month, then the client needs to realize that it will take 20 months of payment before they break even and begin to save money. Sometimes the client will refinance just to reduce the term or the length of the loan, and this saves money on the interest. In other words, changing from a 30-year term down to maybe 20-year term. You can also teach your clients that they can do that on their own, reduce the term of their loan without refinancing by paying an extra mortgage payment or two a year, or by just paying extra every month and having the servicer apply that extra amount to their principal. This will also save interest and reduce the length of the loan. Some people will consider refinancing and using their equity to pay off some bills, like very expensive, extreme medical bills, or to put a child through college, to do home improvement, or to consolidate debt. That little asterisk there is to remind you that this is risky and not generally recommended, especially because it's generally not a wise thing to secure unsecured debt. And, with non-payment of unsecured debt, you are at less risk than if you roll it all into your house and then can't make the house payment, and now you're at risk of foreclosure. So move very carefully into a decision to refinance for reasons in point number 3 here. When we're talking about subsidies that we've mentioned earlier on in the class, you have to consider the restrictions related to refinancing and resale involved with subsidies. So there's no cash-out refinance allowed with subsidies. A first mortgage refinance could possibly happen, but it's only when the refinance is meant to just lower the interest rates or the term. Again, no cash out. And because the subsidy note holder already is subordinated to the first lender in first position, they will not subordinate their lien for additional financing. That only makes sense. In terms of resale, some subsidy situations may have in the contract a shared appreciation rider where the subsidy note holder gets to share in any appreciation the house has experienced upon the resale of the property. And sometimes there are restrictions limiting the resale to another qualifying home buyer or to an heir. In the back of your book, there is or in the back of this tab, this unit, there is a refinancing activity starting on page 197. You can work on this activity, read the scenarios, and you will be determining if refinancing is right for each of these clients. And the last bullet point there, how would you counsel? Whoops, somebody spelled counsel wrong there. Have to change that. But anyway, how would you counsel each client in these scenarios? And that wraps up Unit 6. Thank you for your participation and enjoy the class.